Welcome back, traders and investors. We have a very special guest on this morning. It's Kenny Polcari, and he is director of New York Stock Exchange floor operations for O'Neill Securities. We'll get a good perspective on the markets from Kenny because he was on the floor in 1987 during the crash, and he's still there today. Kenny, how you doing this morning?
I'm good, and you?
We're doing good on this Monday morning. Earlier in the show, we were talking about imbalances, and we like to talk a lot about what's going on in pre-market trading, the levels given by pre-market, as well as the opening print. We put a lot of emphasis on that. Dennis, you take it away from there.
I just wanted to ask you, we've been seeing this Alibaba imbalance, this buy imbalance, it seems, and we were looking at it, the last 15 out of the last 17 days the stock has opened higher. And it seems like every morning there's like a 400,000 or 500,000 share buy imbalance. Same thing this morning here, 616,000 shares to buy. How do those imbalances come together? Like we know, what they do to the stock. They tend to push the stock higher. But is it, just how do they actually put those together on the floor?
Well, it's very simple, right? So much of it now is automated, but that imbalance that you're seeing, whether it's BABA, whether it's Bank of America or Citibank, whatever, the imbalances that you're seeing are orders that customers, institutions, whether they're clients, whether they're broker-dealers, are putting into the system before the opening. And so they are market orders, some of them are limit orders, some of them have, if the last sale is $117, somebody might be willing to pay up to as much as $120. And so they'll put their interest into the system automatically. Then the system just aggregates all the information and spits out a number, right? In this case, BABA this morning is, you're right, there's 616,000 shares to buy paired off on 90,000 shares, right? Which really means that there's 716,000 to buy and 90,000 shares for sale. So 90,000 pairs off, and the imbalance is to buy. That imbalance then gives you an indication that clearly the stock would look higher. Now, how much higher, it doesn't necessarily tell you, but if you go to the pre-market, if you type in BABA in your Bloomberg system or one of your quote systems, you'll see that currently it is trading up at $117 a share. So it's up $2.50 from where it closed on Friday night, only because clearly there's this indication to buy. Now, in the next hour and a half, if all of a sudden people start entering before the opening, they start entering sell orders that they want to execute on the opening, you'll see that imbalance will shrink. It will either pair off, and it won't be to buy or sell. It'll just be paired off, or it could, in fact, actually slip to the sell side. So what you see in the pre-market trading right now may not necessarily be where it's looking at 9:30 in the morning when trading at the New York Stock Exchange opens. Now, in this case, more than likely, it will be higher. It has been. I've seen that for the last couple of days, the way you guys have announced it. That's just trader interest. It's much more trader interest than it is institutional interest, right, at this point.
When you say paired off, and we've got a lot of retail listeners there, they might not understand what you mean. What do you mean by paired off?
All right, so here you go. So you come in, you got 100,000 shares to buy, and I come in and I've got 100,000 shares for sale. You're willing to buy it at any price. I'm willing to sell it at any price. If the stock closed last night at $115, then therefore it's paired off because there's exactly 100,000 to buy. There's exactly 100,000 for sale. The stock would not, on that indication, open higher or lower. It's paired off at the last sale because you're willing to buy it. I'm willing to sell it. Now, if you want to buy 100,000 shares and I only want to sell 50,000 shares, there's an imbalance automatically of 50,000 shares to buy because my 50 only pairs off against 50 of your 100. You still have 50 to buy. So therefore, the pair is 50, the pair off is 50, and on balance is 50,000 additional to buy. So if you're just looking at the last sale of the stock is $114, your initial thought is going to be, okay, there's stock to buy. The stock is going to open higher. How much? You don't know yet. You could get an indication based on where other people are trading it in the pre-market, and that's exactly what you're seeing today. Right now, it's trading at $117. So it's up $2.50 based on this early indication. But listen, there was a lot of news last night, right? China came out with that big news about November 17th. They're going to open up this direct connection between Hong Kong and China. Certainly, it's going to make those Chinese markets more accessible. You saw China rally 2.3% overnight, so it certainly makes sense that BABA is going to be to buy because today BABA represents, for most Americans, access into the Chinese market, right? Because the Chinese market is very difficult for the normal American, or really for so many people to access. So BABA has become almost, a proxy for the Chinese market. So it makes perfect sense that you're going to see this imbalance.
We're on the phone with Kenny Polcari. He's director of New York Stock Exchange floor operations for O'Neill Securities, a veteran of the markets. Kenny, one question along these lines. Let's say you're holding a 150,000 to buy ticket in your hand for BABA. That's not being reflected in the imbalance. When do you
That's correct.
what is the last second that you can disclose that to the designated market maker to participate in the opening print?
Okay, so well, the last minute is really at 9:29:59 seconds, right? Because the bell rings at 9:30, and if everything goes off just the way it's supposed to, that stock would open immediately at 9:30. Now, here's the deal. A lot's going to go into my decision based on my conversation with my customer. My customers all tend to be, they are all institutions. I don't do a retail business. So my customers are, could be hedge funds, could be mutual funds, could be a pension plan, could be any asset manager. But at that point, that customer is giving me an order to be his eyes and ears to reflect his intent on the floor at the moment. So what I will do leading up to that point is starting at 9:15, 9:20. I'll go out there. I'll get a look. What's it look? Oh, there's 600,000 to buy. What's the indication? Well, the indication might be $117, $118. That's up $2.50 or $3 from where it closed. At that point, I'm going to call my customer and say, listen, without you, this thing is looking up $3 or $2.50. If I put in 50,000 to buy, this is what's going to happen to the price. If I put in 100,000 to buy, this is what's going to happen to the price. And so I give them a menu based on what I could potentially do, but ultimately what he is going to do, because really I'm acting on his behalf. So he ultimately gets to make that decision. Now, up to that point, I can hold the opening based on real institutional interest that I have until it's I've made the decision, the customer's made the decision, and then I've entered the order. So ultimately, yes, should it be in there by 9:29 and 59 seconds? Sure, but if I need to hold the opening because there's news out, there's news pending, or there's, like last night, there's news out in the Chinese market, it's certainly going to affect BABA today. I would suspect that BABA will open a little bit after 9:30 today because there'll be plenty of interest in there.
Okay, Kenny, I'm gonna rack your brain a little bit on this one, and just going back to your experience during the 1987 crash. Do you remember, where you were working, what you were doing, and what were your reactions to those events?
I remember it like it was yesterday. That's one of those memories that you don't easily forget, right? Whether it was 1987, whether it was 9/11, whether it was, some other big news event day, those are days you just don't forget. And so 1987, I was 26 years old. I'd been a member for a year and a half. I was working in the main room at the time. There were 4 trading rooms that made up the floor of the New York Stock Exchange. My business was based out of the main room, which was the original room when they built the building back in 1903. I remember that leading up to that Monday, on the Friday before, the week before, the Wednesday, Thursday, Friday, the market had come under extreme pressure, right? It was not normal. And I remember going home on the Friday night, and the market had closed on the lows on heavier volume, and saying to my wife, something just doesn't feel right. It doesn't feel like I've ever seen this before. Now, granted, I was only 26, so I hadn't seen a lot, right? And the weekend came, and then Monday morning, don't forget, Monday morning, on Sunday night, Asia opens, right? It's Monday morning in Asia on our Sunday night. We go to bed. I get up Monday morning, get onto the train, get my newspaper, but I'm reading what happened on Friday night. I have no idea what happened on Sunday night. Meanwhile, the world was imploding, right? The Asian markets had started to crack. Then the European market started to crack. And then over here this morning, or that morning, not this morning, on that morning when I got to work, the phones lit up, and every order was a sell order. And it wasn't sell 5,000 shares of GE or sell 2,000 shares of Citibank. It was sell 150,000 GE, sell 300,000 IBM, sell 200,000 Johnson & Johnson. These were big, massive institutional orders, but they were orders that everyone had. All these brokers on the floor had all these sell orders. There was at that moment a lack of buy side. And part of that was a direct result of, I would characterize it as kind of the first indication of where technology was going to take us. Because back in 1987, there was a product designed called Portfolio Insurance, and it was a risk management program completely designed by a computer system, right? It was the beginning kind of the quant people, right, where they responded to what the computer told them to do. So if the computer told them to sell it, they sold it. If the computer told them to buy it, they bought it. They allowed the computer to make the decisions, and they took themselves out of the equation. And so on that day when this happened, this portfolio insurance product took in all this data that had been happening over the prior week and over the weekend, and technical levels that were broken and macro data indications from around the world, and it spit out a message on Sunday night to all these asset managers that had purchased this portfolio insurance product. This product was designed, as insurance is, to protect the portfolio. And so after Friday night's action, it sent out this message that everyone had to sell 2% of their portfolio in order to raise cash to protect the portfolio. Well, here's the deal. You manage $100 million. The other guy next to you manages $1 billion. Your 2% is very different from his 2%. And so therefore, everybody who bought this product, and they were asset managers around the world, all got the same message. And so everybody hit the sell button. And so selling begets selling, because the more selling that happened, the more technical levels that were pierced and broken, which then caused that risk management system to initiate more sell orders, because they were supposed to raise cash to protect the portfolio. And so selling begets selling, and literally it was this dramatic meltdown. I mean, think about this. Johnson & Johnson had closed on Friday night at $96. On Monday night, it closed at $45. It lost 50% of its value in 6 hours of trading. Now, think about Johnson & Johnson. Think about Johnson & Johnson. Is it going out of business? Probably not. It's a consumer stock. They make baby powder and stuff, right? Is it really going anywhere? No. But why did they take 50% out of the market? A couple of reasons. Number one, because it's a big name stock, and so therefore it's easy to sell, and people could sell it rather easily. In this case, they took 50% out of it, though, versus a mid-tier or secondary or tertiary stock, which was much more difficult to sell. So when people had to raise cash, they immediately go to the ones that they can raise cash easily. Hit the sell button, bang, they can sell it. And so you saw this complete meltdown. But I remember that day like it was yesterday.
Wow, that's incredible. And how did that day compare with the flash crash of May 6, 2010? Were you on the floor that day too?
Of course I was, but the truth is there was honestly no comparison, because in October 1987, it was a manual market, right? We traded an eighth of a dollar. It was open outcry. There was very little automatic order delivery capability to the system. And when markets come under pressure, then, especially because it was still very human based, is that customers wanted to talk to people, right? They didn't want to just put it in the computer. They wanted to talk to somebody. In the flash crash of 2010, here I was sitting on the floor. We were in the middle of the great financial crisis anyway. Markets around the world had been under pressure. European markets were under pressure. Our market was off 150 points at 130 or quarter to that day anyway, which was kind of, at the time, that was normal. It was normal based on what was going on in the world. So there was nothing necessarily out of sorts with that. But then what happened is that order that was entered by an asset manager out of the Midwest got entered into the system. The young man that entered that order failed to properly assign, because he entered it into an automated system, right? He entered it into a computer, wasn't a human being, didn't talk to somebody on the other end, say, this is what I want to do. He went into the system, he enters this order, he enters it erroneously, he hits the sell button, and just like, when you get really pissed off and you write somebody an email and you hit the send button, and right after you hit the send button, you go, oops, damn, I didn't want to send it, but it's gone. Yeah. And so the minute he hits the send button, it's gone. Yeah. And so the market then started to spiral out of control, because partly what happens is there were two, and we could talk about this all day. But
this is awesome. I could talk about this all day with you too.
Well, listen, there's a much bigger story here. But what happened in 2010 is because there were two sets of rules, and you have to understand, after 9/11 and after Reg NMS, when the industry started to go through real massive transition, and automation became, kind of the roadmap of where we were going. Automated traders did not want to abide by the same rules that human-based New York Stock Exchange traders had to abide by. They thought, we're automated, we're computers, we don't want anyone touching our orders, we just want to hit buttons and be happy. And so therefore they convinced the SEC and the government to allow them to have a different rule set. Meanwhile, we, in a human-based market, pounded the table down in D.C. saying, listen, you can't be in the same market and have two different rule sets. Doesn't make sense. But they convinced, the automated guys convinced the SEC that two different rule sets were fine. So here's the problem that happened in 2010. As the orders now start coming through the system, when somebody enters an order to sell the futures then that order then automatically generates all the underlying individual equity positions that are in it. So then what happens? It generates either sell orders or buy orders, depending on which way you're trying to do it. In this case, though, this order was so large that it generated orders like sell 150,000 IBM at the market, sell 300,000 GE at the market, sell 200,000 Johnson & Johnson at the market. Well, those orders all get created automatically, and then they get delivered automatically. So think about this for a minute. Just use your head for 1 second. Who in their right mind is ever going to send an order to sell 130,000 shares of $150 stock into a computer system with no instructions, no parameters, no nothing on it? This is the stupidity in it, right? This is where once again the technology spun out of control, because there were in their world, there were no safeguards. And so what happened when those orders get generated and they come through the system and they appear here at the New York Stock Exchange and they appear at the specials post, and the specialist who's an IBM or Johnson & Johnson or Procter & Gamble sees an order like this, his first reaction is, there's something wrong. This does not feel right. But the rule says you have to take the stock down X%, depending on what the stock trades at. Dictates the move. It's 3%, 5%, 10%, whatever the price is, right? And whether the capitalization of the stock is, and they're all different. So for instance, all these stocks came down and they traded down to those levels, down those percentages, and then when that happens, we at the human-based market get to say full stop, turn off, shut the door, don't let anything else in, because this feels like it's a mistake versus being legitimate, right? Yeah. So the minute the New York Stock Exchange shut the door, the way the rule set read, based on what the automated guys want, they could then avoid us and they could just trade amongst themselves. They no longer had to come to the listed primary exchange. Okay, so look what happened. The minute we shut our door, those automated systems could no longer read the quotes. They couldn't read where the buy side was. They couldn't. So what happened in the automated systems? All those automated in split seconds, all the bids canceled because they didn't know where the bid was. They could no longer see it, because stocks like IBM or Johnson & Johnson or Accenture had stopped trading here for a minute, right? So we saw Accenture trade down to a penny in the automated markets. It was a $40 stock that traded down to 36 here. We stopped trading. In the automated markets, they traded down to a penny. Think about being the CEO of Accenture when you look up and you see a stock trading a penny. And you scratch your head, you go, excuse me? And so what happened, that all happened in a very short period. It was 8 or 9 minutes, and the market was down 1,000 points, right? And I'm sitting there in my booth, and I'm watching it. It goes from down 150, down 2.25, down 325, down 475. And I'm looking at my partner next to me, and I'm going, what's going on? You almost think that something happened. You almost think that this president got shot. You almost think that some event would have happened, but yet nobody knew anything. There was nothing on Twitter. There was nothing on the news. There was the people just sitting there kind of watching it unravel. And it unraveled very quickly until it got down, it was 9 or 10 minutes and the market was down 1,000 points. And then the stop logic functionality in the automated market kicks in because, the computer finally realized that this is stupid. And so they then prevent further executions. The market then stabilizes, and then what do you think happens? Naturally, Accenture, which had been trading at $40, now trading at a penny, immediately jumps right back and trades at $40, where it should have been trading in the first place. There was no reason for it to have been knocked out of line, nor Johnson & Johnson, nor IBM, nor Procter & Gamble. And so what happened is once they realized that and the automated system was shut off and trading it back to normal, you saw exactly what happened. The market then rebounded, and it went down to where it was, down 150 or down 75 points, whatever it was. But it bounced right back. And after that event, it then became clear, even though it took the SEC some 12 or 18 months to quote-unquote analyze it, if you notice today what happened, the rule set now says that the U.S. capital markets trade under one rule set. The rule set happens to be, guess whose rule set? The rule set we had in the first place. The minute the stock trades down X% based on its market capitalization, the primary market gets to say full stop. If the primary market says full stop, nobody else, not one other venue, can continue to trade that stock. That makes perfect sense. That's not the rule set that was written in place in 2010. Because the automated guys, they didn't want to play by the human-based rules. They thought, human-based guys, the human guys, they're a bunch of dinosaurs. Why do we want them? We want to just trade in our computer. Well, okay, now you have a market meltdown, and everyone wakes up and says, what are we doing?
Kenny?
So today,
Go ahead, Kenny.
today, even though the automation still exists, it's great, it's fine, I use it all day long. the rule set now is reflective of what our rule set was in the first place.
Wow, Kenny, we've already kept you over 5 minutes. I can't tell you how much we appreciate it. Kenny Polcari, Director of New York Stock Floor Operations for O'Neill Securities. Kenny, we could probably keep you on all day. Do you think you can come back on the show again?
I'd be happy to come back on the show, but you see, you catch you like this. Now you can almost hear it in my voice, right? Because I could talk to you all day about this because I have a very definite view on what we have versus what I think it should be, and it's a combination, right? But yes, I'd be happy to come back on your show if you think the listeners want me.
Oh, it's great, and Dennis and I couldn't agree with you more, right, Dennis?
Oh yeah, I totally agree. Like you need to have some type of human involved because when you don't, crazy things happen.
Okay,
Well,
Kenny, go ahead, Kenny.
Oh. No, go ahead. I'm sorry.
I was just going to say, thanks again for coming on. One final comment, Kenny?
Listen, I think not so much, but I think people should just beware over the next six or 7 weeks as we move into the end of the year. They should expect some volatility as we probably will test a little bit higher, maybe test a 50-day, and then probably my guess is we're going to end right about where we are today.
Okay, thank you.